start over. So anyway, thank you so much for the opportunity to come here and to share our perspective about the state of the global economy and what it could potentially mean for a variety of different markets, including interest rate markets, equities, currencies, and maybe even touch very briefly on a couple of commodity markets. So before we begin, I do have to show you both the short version as well as the longer and more detailed version of CME Group's disclaimers, which basically say that because we are an exchange operator, we have to remain a neutral counterparty. And so we are not able to give any sort of investment advice. So with that in mind, I thought we could start about one of the major topics in the world, which is the state of interest rate markets. As I'm sure you have seen in recent weeks, many central banks have begun cutting interest rates. The Federal Reserve recently cut interest rates by 50 basis points. And if you look at the forward curve for the futures market for interest rates, the markets expect that the central bank will cut a further 25 basis points in November, another 25 basis points in December, two more 25 basis point cuts in January and March. And then it will most likely slow down the pace of its cutting to once every other meeting. But the markets are pricing cuts in June and September of next year. So at the moment, the expectation in the markets is for the Federal Reserve to cut another 150 basis points off of rates between now and this time in the year 2025. I would warn you, however, that the market's expectations are extremely volatile. Here in this chart, the black line represents the actual Fed funds policy rate, whereas the two blue lines represent where the market believed that the Fed would be in 1 year's time or in 2 years' time. And as you can see, those market expectations can move very, very rapidly. And so, at the moment, the market's thinking is that the Federal Reserve will eventually wind up with rates around 3 3/8%. Now, what's interesting about this pricing is that the pricing is somewhere between what you would expect for a soft landing and what you would expect for a recession. So the market can't quite seem to decide if we're going to have a soft landing where the economy slows down but continues to grow, like we had in the middle of the 1980s or like we had again in the middle of the 1990s, or whether the economy will experience a hard landing and an actual economic downturn. Now, in the past, when we've had economic soft landings, the Federal Reserve usually only cuts rates by perhaps 75 basis points. And so right now, the market is pricing another 150 basis points on top of the 50 that we've already had. So the market essentially is pricing at the moment 200 basis points of rate cuts, which is more than what you would typically have during a soft landing. By contrast, during recessions like in the early 1990s, the early 2000s, during the global financial crisis, the Fed cut interest rates by 500 basis points or more in each of those three recessions. So if we have a recession, it would be very easy to imagine the Federal Reserve bringing rates down below 3%, maybe to 2%, maybe to 1%, maybe even to 0 in the case of a particularly severe recession. Now, that said, I think the idea that the Fed goes back to 0 rates is very unlikely. For the simple reason that inflation remains more elevated now than it was before the pandemic. Before the pandemic, inflation rates in the U.S. were averaging around 2%, excluding food and energy. Now those inflation rates are averaging closer to 3.3%. So the Federal Reserve probably can't bring rates all the way back down to 0. But if we do have a recession, it's easy to imagine them bringing rates down perhaps to 1% or 2% rates. The other feature of the U.S. economy that I think is very interesting is that we have an inverted yield curve, which is to say that short-term interest rates, as determined by the Federal Reserve, are significantly higher than long-term bond yields, like 5-year, 10-year, or 30-year U.S. Treasuries. And the yield curve has now been inverted for a period of more than 2 years. And not only is the yield curve inverted, not only are short-term interest rates higher than long-term interest rates, the yield curve inversion is the steepest inversion that we've seen since the early 1980s. Also, I would point out that the last time that we had a yield curve inversion that lasted even half as long was in 2006 and 2007. And that particular episode of yield curve inversion was followed by an extremely deep recession during the global financial crisis. So the inversion of the yield curve does raise the question, is the United States headed for an economic recession? And so this is a question we'll try to answer over the course of the presentation. So I would also point out that the U.S. has for a long time been seeing declining interest rates. From the early 1980s until 2021, the general trend of both short-term and long-term interest rates in the U.S. was downwards. But recently, as a result of the wave of inflation that washed over the world economy over these last few years, that downtrend in interest rates has been broken. So we now have the highest short-term interest rates up until recently that we had since 2001, and the highest long-term bond yields that we've had since 2009 and 2010. Now, during this very long period of generally declining interest rates, there were a number of periods, including in the late 1980s, which you can see here. Around 1989, we had a yield curve inversion. We had another one here around 1999, and we also had one here in 2006. All of these periods of yield curve inversion were followed subsequently by economic downturns. And so one of the questions is, will this period of extraordinarily steep inversion of the yield curve result in a recession? So another way of looking at this problem is to look at the slope of the yield curve, which you see here in light blue, versus the GDP growth rate, which you see in the solid black line. And so you can see that back here at the end of the 1970s and early 1980s, we had very steep yield curve inversions that in both cases were followed rather quickly, within about 12 months, by an economic recession. Since the early 1980s, the length of time between a yield curve inversion and a subsequent economic recession has seemed to get a bit longer. And I think that that was a result of financial innovations that took place during the 1980s, including the creation of the mortgage bond market and the creation of high-yield corporate bond markets that allowed banks to essentially sell loans off to private investors and encouraged Americans to go on longer-term fixed-rate mortgages, and in the case of high-yield bonds, allowed a wider variety of companies, including companies with lower credit quality, to access the U.S. and therefore the global bond market. So you'll notice here, for example, we had a yield curve inversion in 1989, which was followed by a recession around 1991. We also had a yield curve inversion in 1999 that was followed by a recession around 2001. And we also had a recession here, a yield curve inversion rather, in 2006 and 2007. That was also followed by a very deep recession during the global financial crisis. And so the question is, will this particular yield curve inversion also be followed by an economic downturn? Well, I think that one of the most difficult things for both investors as well as central bank officials is the lag time between when a central bank changes monetary policy and when the effects of those changes are actually felt on the economy. And so one way of measuring the lag time is to calculate the correlation between yield curve shape and GDP growth. So if you calculate that correlation with no lag time, so for example, the yield curve at time t versus the GDP growth rate also at time t, the correlation is actually negative. So what typically happens is that when you are going through a period of very strong economic growth, you often have a very flat or inverted yield curve because the central bank will have raised interest rates. By contrast, when you're going through a period of weak economic growth or recession, you often have a very steep yield curve because the central bank will have put interest rates near zero. However, if you take the gross domestic product's growth rate and you begin lagging it through time, you find that this correlation turns positive. It actually becomes very robustly positive. After about 2 years, the correlation peaks out at nearly positive 0.6, which is a reasonably strong correlation. And so what it suggests to me is that when the Federal Reserve changes its interest rates, it takes between 2 and 3 years for those interest rates to work their way through the economy and to either slow the economy in the case of rate increases or accelerate the pace of growth in the case of rate cuts. So at the moment, the U.S. economy continues to show very strong growth despite the Fed's tightening cycle and despite an inverted yield curve. But I would point out the same thing was the case back here in, say, 2006 when we had an inverted yield curve. The economy was still growing at 2.5% per year. Back here in 1999 when we had an inverted yield curve, the economy was growing at 5% per year. Back here in 1989 when we had an inverted yield curve, the economy was growing at 4 or 5% per year. So it's not unusual for the economy to continue to grow in the short term despite Fed tightening. However, there are, I think, many signs that the U.S. economy is beginning to head towards an economic slowdown. First of all, if you look at that GDP growth rate in the United States, it's a 3.1% growth rate year on year. But if you look at the second half of last year, the economy was growing at a rate of 4% annualized. In the first half of this year, only 2% annualized. Now, in a few days, we will get out the first estimate of the third quarter GDP. My guess is it comes in a little bit on the soft side and certainly lower than a 4% growth rate that we were seeing during the second half of 2023. So another way of observing this phenomenon is to look at what's happening with Federal Reserve interest rate increases and subsequent recessions. So over that 40-year period of time, during which interest rates generally fell, there were 6 times that the Federal Reserve raised interest rates. Now, 2 of those in the mid-1980s, the one here ending in August 1984, and the one in the mid-1990s, ending here in February 1995, the Fed raised interest rates and there was no recession. We had a soft landing. And this was, by the way, a great scenario for the equity markets. In 1985, 1986, and up until August 1987, the stock market soared in value. The stock market went up something like 170% during that time. A phenomenal performance. In the mid-1990s, in 1995, 1996, when we had a soft landing, the stock market had a spectacular performance, up more than 30% in 1995 and up another 25% in 1996. By contrast, when we had recessions, the stock market didn't do so well. But there's a couple of things I would point out here. First, those soft landings followed Fed rate hike cycles that were relatively small. In each case, in the mid-80s and mid-90s, the Fed hiked rates by about 300 basis points. This time around, the Fed hiked rates by 525 basis points. So their rate hikes were much larger than what we saw previously. Secondly, in the mid-1980s and mid-1990s, there was no yield curve inversion. So the Fed raised short-term interest rates, but they didn't put them above long-term interest rates. And so the reason why yield curve inversions are important is because the banking system makes money by borrowing from depositors short-term and then lending long-term, for mortgages, for corporate loans, for household loans, for auto loans. So when the yield curve is very steep, lending is more profitable, and banks will take more risk and extend more credit to more different kinds of borrowers. By contrast, when they raise short-term interest rates and invert the yield curve, banks naturally become more cautious, and they begin raising their lending standards because it causes their profitability to decline, so they're not willing to lend as much money to higher risk customers. And so in the cases in which we saw yield curve inversions, which was the late 80s, the late 90s, before the global financial crisis, and also in the late 2010s, just before the pandemic, in each case we did have a recession. But the recessions took a long time to begin. So for example, the recessions took anywhere from 10 months to as many as 18 months after the Fed's last rate hike to even begin the recession. And the Fed's last rate hike was in July 2023, which was 15 months ago. So right now, we are right in that zone between 10 months and 18 months after the last rate hike, when historically the economy has been at greater risk of recession, especially during periods of yield curve inversion. And this could also have a lot of implications for the stock market. In 1990, the stock market had a kind of small bear market, down 20%. But in 2001 and 2002, the S&P 500 fell by 50%. The NASDAQ index fell by 85%. During the global financial crisis, the S&P fell 60%. And at the beginning of COVID, not really probably because of the yield curve inversion, but let's point this out anyway. At the beginning of COVID, the S&P fell by about 30 or 35%. So if we do have a recession, the consequences for the equity market could be very significant. And I know that there are people who are saying, well, first of all, the Federal Reserve has begun cutting rates already. So will that prevent a recession? And the short answer is no, it will not. And the reason why we know this is that here in 1990, the Federal Reserve started cutting rates in June 1989. 1 year before the recession began, they were already cutting rates. Did it stop the recession from happening? No. Likewise, early 2001, January, the Fed cuts rates twice by 50 basis points in a single month. Did it stop the 2001 recession from happening? No. Likewise, in 2007, the Fed started cutting rates in September 2007. Did it stop the global financial crisis from happening? No. It happened anyway. Why? Because when the Federal Reserve raises rates or cut rates, it takes 2 to 3 years for it to begin to impact the economy. And I'd also point out very briefly that the stock market in 2007 didn't even hit its high until the end of October 2007, which is really crazy when you think about it, because by October 2007, it was abundantly obvious to everybody that there was a major crisis going on in the United States. Unemployment was rising, the banks had stopped lending to one another, and real estate prices were collapsing. And yet the stock market continued to go higher. So some people are telling me, well, the stock market continues to go higher, so therefore there'll be no recession. To which I say, don't be so certain. The stock market is not always a very good indicator of where the economy is heading. Now, let's take a deeper look inside of the US economy and see what the evidence is. So last month in September, we got a very strong employment report, which was released on Friday, October 4. And so this employment report came in much stronger than expected. So it sent bond yields higher. The equity market was more or less happy with it. But I would warn you that the US employment picture is very complicated, and it's not as strong as many people would like to believe. So in the United States, we get two entirely separate surveys of the employment market every month. And they come out at the exact same time, usually on the first Friday of each month, which I think would usually be around 9:30 or 10:30 in the evening here in Korea. And so these numbers come from two sources. The first source is a survey called the Establishment Survey, which is mainly a survey of big business. And this survey gives us some of the most widely followed numbers, including non-farm payrolls, average hourly earnings, and the number of hours worked. And this survey has been showing very, very strong growth in the employment markets in the United States. However, there is also a second survey. And the other survey is called the Household Survey, which is a survey of 60,000 American households. And over the last year, this separate survey, which gives us the unemployment rate as well as the labor force participation rate, has been painting a very different picture of the state of the US economy. So you can see that non-farm payroll employment from the Establishment Survey has been showing very, very strong growth. By contrast, the Household Survey has been showing that there's been almost no growth in the job market at all. So in the next chart, we'll take a look at these same two series, but we'll just look at them up close. So you can see the non-farm payrolls number has increased by nearly 2 million jobs since the end of November. So that's showing the US economy is very strong. By contrast, the Household Survey has been showing that we've had almost zero growth in employment over the last 10 months. So how can they be so different? Well, the Establishment Survey, I think, is picking up on the strength of large enterprises in the United States, and it's ignoring what is happening at small and mid-sized companies. So what's the difference between big and small companies other than size? Well, first, many large corporations in America have large quantities of cash, and that cash is now earning 5% per year simply by being invested in T-bills. Secondly, many big companies in the United States issued bonds during the pandemic, long-term bonds that allowed them to lock in cheap financing when interest rates and bond yields were ultra low back in 2020 and 2021. And so for them, higher interest rates is actually kind of a good thing. They're earning money on their cash, and they're not paying a lot of money to finance their long-term debt. Now, by contrast, small and mid-sized enterprises typically don't have such a large amount of cash. And secondly, almost by definition, small and mid-sized companies do not issue bonds into the bond market. That's something that's really only for big companies. And these small and mid-sized enterprises, on average, their loans have a duration of 2 years. And so they borrow money from banks, on average for about 749 days, according to the Federal Reserve, which is about 23 months. And so over the last 2 years, they have seen a tremendous increase in their cost of financing. And so what the labor surveys are picking up is the household survey is showing that small and mid-sized enterprises are laying off staff in large numbers, whereas the establishment survey is telling us that big business is continuing to hire. But I think that the household survey is getting us a more comprehensive or more complete view of the state of the labor market in the US. And so we also see this in the equity market as well. You know, if you look at the United States equity market, you can see that indices like the S&P 500 and the NASDAQ 100, which are composed almost entirely of very large companies, are trading very close to record highs. By contrast, if you look at the Russell 2000 index, which is an index of small and mid-sized companies, those stocks have underperformed by 30%, and they're trading about 5% below their record high from 2021. So they're actually lower today than they were 3 years ago. So it's not just the labor market data that is telling us that the US economy is struggling. It's also the stock market that is telling us that small and mid-sized enterprises are not doing so well. You know, you also see this if you look at the unemployment rate. Now, the unemployment rate, to be clear, is the main output of the household survey. And so unemployment in the US has increased from 3.4% back in April 2023 up to 4.1% today. Now, when I went to school and studied economics in academia, I was taught in the textbooks that unemployment is a sort of lagging indicator of the economy. But it seems to me that while that could be true when economic expansions begin, you know, sometimes at the beginning of an economic expansion, unemployment might continue to rise for a while. It's not really true when economic recessions begin. So if you look at unemployment here in the late 1980s, it was falling, then it stopped falling, and then it began to rise before the 1990-91 recession began. You know, likewise, unemployment was falling during the 1990s, then it stopped falling in 2000 and began rising before the 2001 recession began. Likewise, before the global financial crisis, unemployment had been falling. Then it stabilized around 4.4%, you know, hitting its low in April 2007. Then by the time the recession began in December 2007, the unemployment rate had already risen to 4.9%. And so unemployment has actually in the past seemed to be a leading indicator of economic downturns, which is a bit contrary to what we're often taught in school. But here too, you're seeing the exact same kind of bowl-shaped formation where unemployment was falling, stabilized, and is now rising slowly before potentially the beginning of an economic downturn. Now, I think that there are other reasons to be very worried about the state of the US economy that could tell us something about what kind of recession we might experience if there is an economic downturn. Now, in fairness, every economic downturn is different. So the last, say, endogenous or internally caused economic recession, so not counting COVID, the global financial crisis, that was essentially a collapse of the real estate market and a collapse of the banking system. And this time, that's not going to happen. So this time, the real estate market is very tight. There's very little supply of real estate. So real estate prices are likely to remain stable. The previous recession, back in 2001, was mainly a collapse of business investment. consumer spending in 2001 was actually quite stable. It didn't even decline during the recession. So I think if we have a recession, it's most likely to look like the recession that we had in 1990 and 1991, which was mainly a consumer-led recession that also featured a collapse of commercial real estate prices, so declining values for offices, and a lot of stress on small and mid-sized banks. And so the reason why I fear that there could be a downturn in the consumer sector is that the average checking account balance for the American family has declined from $5,500 in 2021 down to just $3,000 today. And so that's about the same amount of checking account balance as people had in 2019. However, prices are now 20% higher. So the real value of that money has actually declined by quite a lot more than is suggested in this chart. Secondly, rents have increased by 30% over the last few years. And then on top of all of that, the cost of insurance and maintenance and repairs for housing and cars is increased by 40% or 50%. So consumer budgets are becoming very, very squeezed. I think another reason to be concerned is that we're starting to see higher and higher delinquency rates on credit cards and auto loans. So for example, we've seen a soaring number of people not able to reimburse their credit card debt. And so that's now increased to its highest level since 2011. Likewise, the number of people not able to service their auto loans has increased to its highest level since 2010. So this is also a clear indicator of a lot of distress on the part of consumers. So one thing that makes me very nervous in the market is the state of high-yield bonds. If you look at high-yield bonds in the US, currently they trade with yields that are only about 3% higher than US Treasuries, which is just about as narrow a yield premium as we have ever seen from the high-yield bond market. So one of my concerns is that we could see a dramatic widening of spreads. For example, during the 2001 recession, spreads widened to between 6% and 8% and 10% over US Treasuries. During the global financial crisis, they briefly went almost to 20% over US Treasuries. So when I look at them trading here at 3%, I think to myself, this is a market with very asymmetric risks. There's a lot of potential risk on the downside in terms of price, but there's not really that much upside risk in terms of return because yield spreads almost never get narrower than they are today. So the most you can hope for from these bonds is maybe a 4% treasury yield plus 3% premium for taking the risk of owning high yield bonds. So really the most you can hope for is maybe a 7% return. By contrast, the downside could be very, very significant. And recently we launched futures contracts on high yield bonds as well as on investment grade bonds that for the first time will allow market participants to hedge against the risk of widening spreads in the futures market. So I should also point out that many other central banks, including Bank of Korea, of course, but also the European Central Bank and many other central banks around the world have been cutting interest rates. And not only are they cutting interest rates, but if you look at the forward curves in these other countries, there is also a very strong expectation that all of these central banks will continue to ease monetary policy. The reason for that is, I think, pretty simple. It's mainly because inflation rates have fallen very sharply all around the world. So this is really good news for the economy. But what is less good news, I think, is that inflation rates remain higher today in almost every country than they were before the pandemic. And so the good news is inflation has come down and central banks are easing. But let me show you what the central bank's nightmare scenario looks like. So this chart here shows you what I think is the nightmare scenario for central banks. So we had this long, very nice period of very low inflation in the United States, in Korea, Japan, Europe, that lasted from the 1990s up until 2020. And that was followed by this inflationary impulse up to inflation rates of around 6 to 7%. Now, as we mentioned, inflation has subsequently come back down, but it has not come back down all the way. And so this is something that we've seen happen before, much further in the past. So if you go back to the 1950s and the 1960s, the US had a period of very low, stable inflation during the 1950s and 1960s. That was then followed by a strong period of inflation in the late 60s and early 70s. It took inflation up to around 6.5%. Inflation rates then subsequently came back down, but they did not come back down all the way. And what happened next was that central banks cut policy, or cut interest rates rather, eased policy. And we then had two subsequent massive waves of inflation later on in the decade. And so why did those inflation rates occur? Well, part of it is because during that time, the President of the United States, Richard Nixon, as well as his predecessor, Lyndon Johnson, leaned on the Federal Reserve, essentially told the Federal Reserve that they wanted easy money for political reasons. So in 1971 and 1972, Richard Nixon faced a re-election campaign, and he wanted a very strong economy in 1972. So he told the Federal Reserve, create a lot of money, and they did. And so in 1972, we had very strong growth, but inflation hadn't shown up yet. And so in 1973, just after he was reelected, inflation rates began soaring. And this, I think, is a risk, especially if Donald Trump wins the election in the US. Donald Trump has said many times in the past that he believes that the White House should play a role in determining interest rate policy. In 2017, when he became president, he was very angry with Janet Yellen, who at the time was the chairperson of the Federal Reserve. And why was he angry with her? Because she raised rates 5 times in December 2016 and then several more times in 2017. So Donald Trump chose not to appoint her again. He replaced her with Jerome Powell, who he thought was going to stop raising interest rates. But Jerome Powell kept raising interest rates 4 more times in 2018. And Donald Trump went on Twitter and attacked him over and over again for increasing interest rates too much. Well, then in 2020, when the pandemic struck, Powell put interest rates back at 0. And in 3 months' time, he printed $3 trillion to buy all of the debt that was being produced by the US government during COVID, and then continued to print $120 billion per month. And Donald Trump was very happy. He said that Jerome Powell was his most improved player. Well, now Donald Trump is angry with Jerome Powell again. Why? Because Jerome Powell cut interest rates 50 basis points last month in the middle of an election campaign, which Trump and some of his supporters seemed to think was aimed at helping Kamala Harris by stabilizing the financial markets ahead of the election. So Jerome Powell's term of office ends in 2026, at which point whoever becomes president could choose to replace him or not. But you contrast this with Kamala Harris and Joe Biden. Over the last 2 years, we have seen more Federal Reserve rate increases than we have ever seen since 1981. And despite all of those rate hikes, there was never even one word of criticism from the White House about the Federal Reserve tightening policy. And so if Donald Trump comes back in and decides to appoint somebody else or puts pressure on the Federal Reserve to create more money, we could wind up with successive waves of inflation. Additionally, this period of low stable inflation during the 1990s, the 2000s, and the 2010s occurred during a period of expanding global free trade and reduced tariff barriers. In particular, it occurred in large part, I think, because China joined the World Trade Organization, which lowered trade barriers around the world. And also, China came in with very low wages compared to other countries that depressed inflation throughout the entire rest of the world. Well, now, the world is moving back towards protectionism. It's moving back towards increased military spending, moving back towards increased conflict. Donald Trump wants a tariff of 10% on all goods coming into the United States and a 60% tariff on goods coming in from China. All of this is very potentially inflationary. And lastly, China is no longer a low-wage country. It's now very much a middle-income country. So I think the conditions are being set not just in the United States, but globally for potentially successive waves of inflation, depending on what kind of policies that we have towards central banks, independence, what policies we have towards trade, and what happens in terms of geopolitical tensions. And what I can tell you is that the period of high inflation during the 1970s was very destabilizing for asset prices. The prices of bonds fell. The stock market during the 1970s sometimes fell, sometimes rose, but overall basically went sideways for about 16 years. But after inflation, the S&P lost 70% of its value. So the stock market went sideways in dollar terms, but the dollars were becoming worth less and less. So what could potentially do well in this environment of large budget deficits, increased geopolitical tension, increased protectionism, potentially less stable, higher rates of inflation? In one word, I think it's gold. And that I will end with because I think the other speakers, the next speakers, will talk about commodity markets, and I don't want to go too much into their territory, but I believe we have some time for questions. Yeah, so that's a very good point. Now, what I think is very interesting here in 1973, when inflation began to soar, is inflation rates were already going higher before the oil shock began. So the oil shock began as a result of a war that started in October 1973 called the Yom Kippur War, in which a number of Arab countries attacked Israel. And so Israel defeated them very quickly in a space of about 7 days or so during this war. And the Arab countries then launched the Arab oil embargo, which reduced their exports of crude oil to the rest of the world and took approximately 5% of global production offline. So the price of oil went from $3 to $12 per barrel almost overnight. And of course, that played a role in boosting inflation. I would also point out, however, that this is core inflation. So it's inflation excluding food and energy. So even prices that were not food and energy went dramatically higher, in part, of course, because all goods ultimately do use energy in their production process. But I would also point out that this was a period of more generalized geopolitical instability. So as the U.S. pulled out of Vietnam, it sent a signal to countries all over the world that the U.S. was in a position of weakness. And as a result of that, other countries began to take advantage of the power vacuum. And so the Arab-Israeli War in October 1973 was one example of that. But there were other examples later in the 1970s with the Iranian Revolution, the hostage crisis, the Soviet invasion of Afghanistan, and Saddam Hussein's attack on Iran in September 1980 that also coincided with the second wave of inflation. So one of my concerns now is that after the U.S. pulled out of Afghanistan, it again signaled to the rest of the world that the U.S. was now abandoning allies around the rest of the world. And within a few months, Russia attacks Ukraine. Within 2 years, another war begins involving Israel and now Iran and its proxies. And I don't think that we have heard the end of this. In particular, if Trump becomes president, he doesn't seem to want to defend any American allies, including South Korea, Taiwan, the Europeans, etc. So we could be in a position of much greater geopolitical conflict if the US retreats from all of Europe and Asia, which could also prove to be highly inflationary.